Hey guys, Eddie here from Dilleen Property. Today I want to do another video talking about buying property using a self-managed super fund and how I bought properties through my self-managed super fund using super money as a deposit, superannuation as a deposit to buy properties. Before I even get started, I'm not a financial advisor. I'm not a self-managed super fund expert or anything like that, but I have bought properties using my self-managed super fund. I'm probably one of the youngest people to do it in Australia. I'm 28 years old. I have 20 investment properties plus in my property portfolio. 3 going on 4 of those are in my self-managed super fund. Basically, I'm going to take it back and explain a little bit about my first transaction property that I bought using my super as a deposit. Basically, I had about 45 to 50,000, let's say 50,000 in my as superannuation. That was with a company called REST, R-E-S-T. A lot of you out there might have heard it before. Basically, what I had to do, and behind the scenes, there was a lot of trial and error. I spoke with hundreds of people, financial advisors, mortgage brokers, and there's a lot of misinformation out there. But this is a very simplified version of what I did. I took that 45,000, let's call it 50K, in my REST superannuation account, and I had to roll it over and create a self-managed super fund. So to roll it over, the self-managed super fund, I had to get an accountant and a financial advisor to set up that self-managed super fund. It entails creating things like trusts, entities, companies, a bear trust, etc. So there's like 2 or 3 kind of trust things that you got to set up. I'm not going to go into the technical side of it, but you got to create like a trust basically, and it's called basically like a self-managed super fund. So you roll your money over. I had to roll basically my money. So my 50K, I had to do the rollover. Roughly behind the scenes, cost me almost about $4,000 to set up all the company trust structures, to set up all that kind of stuff. You have to register. It has to be registered with ASIC and all that stuff as a business. Has to get an ABN number, etc., etc. It's pretty confusing, and the paperwork I signed was ridiculously long. There was like folders and folders of paperwork. Basically, there's a lot of information to go through, and it is very, very complex and complicated. But I'm going to try to simplify it for this video. Long story short, had 50K, paid $4,000, rolled it over to a self-managed super fund, right? So my money was no longer in REST. I had to do a lot of behind the scenes things, from roll that money from here to there. And then the money, the 46,000, that was in now what they call a self-managed super fund cash management account. Now the bank that I was with was Macquarie Bank. So I basically just had an account with about $46,000 sitting in there. Basically, what I did was I took some of my own money and savings, let's say it was about 20,000 for argument's sake, and I dumped it in there. So it brought the balance from 46,000 up to 66,000. I then had 66,000 in that self-managed super fund account. The money was just sitting there, and I then went to get a loan pre-approval or talk to a broker. So basically behind the scenes, I already knew how much I could borrow if that happened, but the broker said, hey, you can borrow about 200,000, 300,000 as an example. So basically what happened is I had 50K originally, 50K. Then I spent $4,000 to roll it over. Then I had 46K in the SMSF. Yeah. And then I added 20, bringing it to about 66K that I had in there, right? So I had about 66,000 in super. Then I bought a property. Let's say for argument's sake, it was about 200,000. So I bought a property for 200K. And out of that, I got the loan. The first bank I went with was Liberty Financial. I've since bought the other properties through Latrobe Financial. So buying a property through a self-managed super fund, 2 lenders that are the best. Take notes on this. One is Latrobe Financial. The other one is Liberty Financial. Now, in terms of banks and lending and criteria and policies, very few banks deal with self-managed super funds anymore. So Latrobe Financial, from my experience, no financial advice, are the best. They will be able to lend you money a lot easier through self-managed super funds. So I went with Liberty the first time, and if I would have rolled the clock back, I probably would have went with the Latrobe, basically, for other reasons, which I'll talk to you about in another video. But basically, I found a property for 200K, so that's an amazing deal, and I use my super money as a 20% deposit. So 20% of 200K, 40,000, right? So I used 40K of this as the deposit. I had around 16K left, sorry, 26K left. And using it with the 26, then I paid stamp duty. Let's say stamp duty is about 5K, miscellaneous fees, such as pest and building fees, solicitor fees, etc., etc. Let's just say that was about 3K. So all up, I bought a property, 48K roughly of my super, and then I had 66. So let's just say there was roughly 18 grand, let's just say 18 grand left over as the buffer in that thing. Whether it's 15 or 20, I don't even remember. Let's just say it was 18K in the middle there. So in the self-managed super fund account, which was the Macquarie account, my balance went from 66 down to, let's just say, 18,000. And I used roughly 46 to 48,000 to buy the property for 200,000. My loan was then with Liberty Financial of minus 160,000. So basically, that's a little bit of the very basic simplified version of how I bought property using my self-managed super fund. You're basically using your superannuation as a deposit to buy investment properties. So I'll give you an example about how leveraging property through your super is very beneficial. So let's just say that in this scenario, this is just a quick example. Let's just say in this scenario, a person had 150,000 in super, right? So you've got 150K in super, 150K. So 150K here, 150K here. So in this example, this is, let's just say over 15 years, right? So over 15 years, and this is without any other contributions. So this one here is a SMSF, and this one here is normal superannuation. Let's just say that without any extra contributions over the course of 15 years, so here's where you start and here's where you finish in 15 years. This 150K, let's just say it doubles over 15 years, right? So no extra contributions, compound interest, leave all that kind of stuff off, but let's just say it doubles from 150K to 300K over 15 years. So you've doubled your money, that's your normal super. 150K went to 300K over 15 years. In this scenario, this is the power of leverage and using leverage to grow your wealth, right? This is what all the famous property investors do, all the millionaires, billionaires, etc. They use leverage. Leverage is the key, right? So 150K, if we use 150K as deposits, because to me, 150K in super is about 2 property deposits, possibly 3. But let's say you bought 2 $300,000 properties, right? So 300, how many deposits are there? Let's say you bought a 300K property and it took 60K of that because you use 20% deposits when you're buying self-managed super funds. So 300K there, and you bought 2 properties for 300K each. And you use 60 and 60, so 120. So you pretty much use 120, and then you would have had maybe a $10,000 to $15,000 buffer because you've got to pay stamp duty, legal fees, etc. But you use 150K as deposits. Let's just say it was a 70K deposit there, 70K deposit there, including stamp duty, legal fees, and both these properties are renting out. But now you've used 150K to leverage in total, when you plus them together, 600,000 worth of assets, right? Not to mention, guys, these properties are going to have tax deductions, rent that's coming in. If this is about a 7% rental return, it's going to cash flow itself, pay for council rates, water rates, management fees, insurance, and you want to buy every property below market value. So if you bought these properties 50,000 under market value or below bank val from the get-go, you would have made $100,000 anyway. because you want to buy it below market value. Every property I buy, it's got to be below market value, below bank valuation. But basically in this scenario, this is just year one. So you've got 600,000 worth of property, and over here, basically, if you've over 15 years, let's just say the property's doubled in value. So they went from, and this is 15 years. Some properties double in 7 years, 8 years, 10 years. Let's just say 15 years, they double. So 15 years, 600K would be worth 1.2 million. Not to mention over 15 years, the loans on these, you would have had loans, but the loans would have gone down, you know, maybe half or 30% or 40%, depending on the loan cycle. So the loans would have gone down, the values would have doubled from 600K to 1.2, and you've got, let's just say about $1 million there of equity, where in this scenario, you've only, without leveraging, you've only got 150K doubled to 300K. So you've got 4 times the amount of wealth behind you, not to mention over 15 years, these rents would have gone up as well. So you would have got tax deductions, probably got depreciation on the property's going up in value, the loan's going down in value. So you're increasing your wealth, and you've got 1.2 million worth of assets with the same amount of capital, as opposed to just going from 150 to 300K. And then you can see this is obviously a lot more volatile a lot of the time, from my opinion. So this is not financial advice, as always, but this is what I see. This is what I'm personally doing, because it makes much more sense to me doing this as opposed to doing this, because that super money is just, you're not using leverage to your advantage. This is buying a house, land, bricks, mortar, having a rental income, the property's going up in value, tax deductions, depreciation. So there's a lot of different things. There's 1,000 different benefits from this scenario as an example. Well, I hope this video helps, guys. If you have any questions, please send them through, and I look forward to seeing you next video. Bye for now.